Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'm going to be discussing the hidden cost of the stock market and the All Ordinaries Index. Now before we jump into the report, I'd just like to mention if you have any thoughts on investing or trading, please remember to comment below. And also remember to subscribe to our channel to keep up to date with new content. So let's get into the report. I am sure many of you would have heard the term you get what you pay for. Another way of saying this is you get what you put in. All too often beginners are after the cheapest version of everything that they can find. In fact, many times I get asked by beginners where they can get something for free. Now you need to ask yourself, what kind of motivation does a person who wants the cheapest thing have? And more importantly, what do you think their chance of success is? However, I don't want to talk about that today. Instead, I want to chat about the costs and, more important, some of the hidden costs in the stock market. There is no lie that there are hidden costs and expenses in the stock market that you need to be aware of, whether it's brokerage fees, managed account fees, entry or exit fees, or others. If you are not aware of what you're doing, chances are you'll be charged more than you realise. There's always a lot of talk around bank customers being charged hidden fees from the banks and others in the financial services industry. Some are even charged for services that they did not even ask for. In many cases, if this occurs to you, what happens when you investigate is that you realise that you've actually agreed to them without knowing it because you did not check the fine print, or one of the thousands of emails you got in one day advised you charges were being added or increasing. Earlier this year, I wrote an article for a leading money magazine about retirement savings for millennials. If you haven't read the article, the link will be in the description of this video. What I shared with readers was the effect that 1% extra in your account keeping fees in your retirement savings and what it can do to the fund. In short, it could cost you half of the money in your retirement. Yes, you heard it right, half. That sad reality is that most people are paying too much in servicing fees. Worse still is that they are not doing anything about it. Now you cannot tell me that you don't care about paying more fees, because I think most people do. Maybe we lack action because we're not sure what to do, or we deem it too hard or too big an effort to try and tackle the bank. Now when you look at the big picture over decades, you realise that extra fees can be half of your entire life savings. Isn't it worth spending a little time ensuring you're getting the best deal possible? Look at it this way, it's not just a few dollars per month, but a few thousand in the final years of growing your retirement savings. The same thing applies to the stock market and investing in general. Investors often overpay for services such as stockbrokers, who often provide them with average advice and at times mediocre investments. In most cases, people with just a little bit of knowledge can do better themselves than getting stock tips from brokers. So why would you pay extra for no added value? Investors are far better off learning a few simple rules around buying and selling, and this allows them to use an online broker who just processes trades and does so more cheaply. Now again, you do pay for what you get, so you need to ensure you are getting value for the services that you use. Sometimes all it takes is a little common sense and some effort, and you can easily reap the rewards. Often I find those new to the market are paying for services they simply don't need, and sometimes their bills can run into hundreds and thousands of dollars per year. Areas you need to look at where costs can blow out or are unnecessary include broker commissions, management or custody fees and charges, acquisition costs, and platform fees. They're a big one. Hidden costs that are promoted in services that offer free brokerage. These can add up a lot. Remember, nothing in this financial world is free. Fees are hidden in the bid-ask spread. Now, there are also transaction costs hidden within underlying funds, such as ETFs. Whether you are an investor or trader, you will pay fees, and you need to know what they are, as extra fees will eat into your profits, and these extra fees affect your compounding of your capital. It's important to remember that everyone in the financial services industry wants to get some of your money, and it's your job to ensure you get value for your money. So let's get into the charts. Okay, on your screen right now, we've got a weekly chart of the All Ordinaries Index, and hasn't this week been fantastic? It's really starting to confirm what we've been thinking now, that the past few weeks have just been a short-term correction in the market before the bull market returns. And as you can see on your screen, last week, we're on this week, the first week of June, the market fell to a low of 6141 and it closed at 6104. So it fell down to that 38.2% level that I was talking about. And so far this week, we've seen a really, really nice rise. Now, I don't have the close at the moment because I'm recording this about 2 hours before the close on Friday, but it does look strong. The whole bar looks strong to me. Currently, it's around 6169 points for the close. So what I'm expecting now is for this market to continue to trade up. It will trade through this 6,244 points over the coming weeks. And I think we're going to have 4, 5, maybe 6 weeks up on this market. If I just put a little bit of another little tool on it, I'll tell you roughly where I'm thinking it's going to go. You can see here, it's probably going to look at getting up to around that 6,300 up to 6,500 points over the coming few months. I think the next half or the second half of 2018 is going to be looking really good. If you haven't seen our hot stocks for 2018 report, go and have a watch of that. And remember, like the channel. If you subscribe to our channel, then I can keep you up to date with these reports and also give you some stocks to look at. But right now, at this point in time, I do think the Australian market is bullish, and there's some really good stocks there. I've just been going through a whole lot of stocks for our students and some recordings for them where I've really pulled out some of the sectors and telling them where to find some great stocks at this point in time. So as you can tell, I'm a bit excited about the market right now. I'm going to cover 3 stocks. I had an email coming through from one of the people that have been watching these YouTube videos, and they've asked me to cover 3 stocks. Now, before I really get into them, I'll show you the 3 stocks of Pioneer Resources, which you can see on your screen now. Lithium Australia, you can see there as well now. And the last one is Sky and Space Global. One thing I'll look at here is Sky and Space Global. It's around 8 cents. You can see there. It's around 8 cents. Lithium here is around at about, what's that sort of, about 12 cents. And PIO, Pioneer Resources, it's around about that 20 cent mark. First thing, as soon as I see these stocks, is this person's buying cheap. And I'm not trying to be rude to somebody. Often people, when they're new into the market and they're inexperienced, they try and buy stocks under $1 because they think there's 2 reasons. One is they think because if it's a 10-cent stock, it's only got to go 1 cent to make 10%. So, geez, it could go one cent up and I'm going to make some good money. And they're seeing there's big upside. The second thing they think of is I get more shares. If I've only got $1,000 and the shares $1, I get 1,000 shares. But if the shares are $100, I only get 10 shares. So they're thinking more shares is better. And that's a complete myth. If you read my books, you'll understand that buying these sorts of stocks is really, really fraught with danger. So I'm not having a go at the person that's sent this question in and asked me to look at these stocks, and I will look at the stocks in a minute and give you my thoughts, but it's not a smart way to make a lot of money because the chances of getting these stocks right is less than 1%, and most people don't have the knowledge and experience to trade them, and I don't trade them. I really don't. And the reason why I don't trade them is because they're so fickle, they're so volatile, and they're so hard to get consistency out of. And my job as a trader is to lower my risk and make my job as simple as I possibly can. So you'll make far more money out of better stocks. Because if I invested $1,000 in a 10-cent stock and I invested $1,000 in a $100 stock, if both stocks make 10%, I've still made 10%. And the chances of a $100 stock doing 10% is far greater than these stocks doing 10%. Because it's not just about buying in, it's about where do you get out too. And this is where a lot of these people don't know. They might see they might purchase in at 20 cents, for example, on this Pioneer stock. And it might go up 10 cents and you go, wow, I've made 50% in the last 3 weeks. But then the person doesn't get out and it falls back down to 20 cents and they go, oh, well, I'll sell out when it gets back up to that 30 cent mark again, and then it falls down to 15 or 10 cents. And then they go, well, I've lost 50% now. Geez, I can't get out now because I've lost money. And then it goes sideways. And as you can see on this Pioneer Research, it's been traveling sideways since 2008. And if I use my cool little tool, wherever I've got it here, PRP tool, you can see there's massive range in price that it's doing it between here. There's 90% range in their pricing there, but a lot of times through here, people wouldn't be making money. Would I own this stock right now? No, I wouldn't own any of these three stocks. And again, I'm not trying to be rude to anybody, but this stock here is going down on the weekly chart. So again, looking at this, if I go to here here's since, what's that date there on that one? Since November, it's down 56% in price, and it doesn't look great. And there's periods here. This is a very illiquid stock. How I can tell is, without even putting volume on it, I can tell by the shapes of the bars. See the shapes of the bars where all the opens and closes are together. This tells me this is a very liquid stock and something I don't need to be around. And that's what I look for in stocks is, number one, liquidity, volatility, but I look for consistency. Otherwise, you're just gambling with your money, because the less liquid a stock is, the less the averages happen, or the less consistency you have in a stock. And you want more probability on your side, not less. Let's quickly look at lithium, because a lot of people have been chatting about lithium, saying, wow, it's a rare metal. You know, everything's got lithium in it nowadays, all your batteries, you know, for your cars, your phones, and that sort of stuff. And so lithium's got to go through the roof. And I remember talking about oil back 10 years ago. And all the journalists were saying, you know, oil's over $120 a barrel. It's heading to $200 a barrel. You know, it's a rare resource. It's going to run out, so it's got to keep going up in price. And I said, all that happens when something gets too high in price is we find something else that's cheaper to replace it. And there are already today technologies around that don't need lithium to run batteries for cars and mobile phones already, and they're cheaper and they're better. But right now, lithium's making money, so that's where all the resources are going into. Would I buy lithium Australia? Again, no, I wouldn't. It's bearish. Right now, it doesn't look really good at all in terms of it's trading, again, another illiquid stock. If I look at it here, it's going down. Don't buy it because it's cheap, and that's really what I was saying before earlier. If you can see here, since, what's that price there? That's November last year, it's gone down nearly 59%, just under 59%. That's a good way to lose a lot of money. This person possibly would have these stocks. Normally when somebody says to me, what do you think about X, Y, and Z stock? Normally they've got it and they're losing money, or they're not sure how to get out of it. And the majority of people shouldn't be trading stocks like this, but this is telling me that nobody wants this sort of stock at this point in time. So buying something because it's cheap is not a good reason to buy it, because it can go down further. Now, if you watched our top 10 video, or hotter stocks for 2018, second half of 2018, we put up the other day, you hear Janine and myself talking about being on Sky Channel for many, many years, and we did that during the GFC, and constantly people were talking to us about ABC centres and Babcock and Brown and a whole lot of other stocks that were falling, and they kept saying, I'm going to buy it because it's cheap. But then it halved in price, and they're still wanting to buy more because it was cheap, and now those stocks aren't listed on our exchange at all. I'm not suggesting lithium will not be on our exchange for a long time. I'm just saying there's no reason to have it in your portfolio right now, because it is pure speculation. Here's another one, Sky and Space Global. Again, would not own this stock at this point in time. Again, very liquid. You can see here right through this sort of areas here, very liquid, and it just keeps falling. It's fallen since this high here back in March 2017. It's fallen 72% in price. Now, that's not a good stock to buy. Again, it's under $1, that's okay, but it doesn't mean it's going to stop falling. It may, and all too often people say to me, oh, look, you know, it's drilling, or this is doing this sort of research, and they're just about, the FDA is going to announce this, all sorts of different reasons for why price should go up. But to me, there's one golden rule that I have as a trader, and to me it's really important for you to understand, is always, always, always trade on confirmation, not speculation. So listening to news and media reports about what a stock could do or what it might be doing is all pure speculation to me. I will never buy a stock unless it's going up, and all of these three stocks are going down at the moment, and I need to assume they continue to go down until they don't anymore. When they don't anymore, then I might look at them, but again, these stocks are more illiquid, and they're not really even in my radar. So again, it's a really good learning lesson for you if you are looking at stocks like this. It's not a smart way to make a lot of money. So good luck and good trading. Talk to you next week. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.